Hi guys, it's Stock Curry, and we saw a massive rally in the stock market on Tuesday. The question is, will it last, or is this just a bull trap? So in today's video, I'm going to go over some historical analysis. I'm also going to go over some technical analysis, as well as some psychological analysis to try to answer that question. Now, at the end of my thesis here, I'm going to open it up to your questions. Now, I want to be clear that in today's video, we're not going to go over any individual stock picks, but rather we're going to discuss the overall market in general. So go ahead and start thinking about what questions you have for the overall market, and we will get to them after I go through what I'm going to talk about. So first of all, as we know, the market in general kind of went up across the overall board. There really wasn't any one sector that was higher or lower than the others. I mean, this was just all around general straight up green. And it was great. It was a really, really wonderful day. Even Jerome Powell, as he spoke, and believe me, Jerome Powell was not bullish at all. It was pretty bearish in the markets. But even as he spoke, obviously he kind of tanked the markets while he spoke. But then after it was over, the market just rebounded and kept going up, finished at the highs of the day. It was absolutely incredible. So let's go take a look. Let's start with some technical analysis. And then once we get to the technical analysis, I want to go over the historical analysis because I think the historical analysis is really going to open up your eyes as to what's going on here. And then we can kind of talk about whether this is going to continue or not. So the first thing I want to look at is this is QQQ. The QQQ is a NASDAQ 100 ETF. Okay. So taking a look at this QQQ, and I'm going to zoom in here. So hopefully we can see this a little bit better. Oops. There we go. Okay. So obviously we had this massive drop for the past, I don't even know what this was, like 4 weeks, 5 weeks, something like that. I'm going to go to the weekly chart. Let me see. 1, 2, 3, 4, 5. Oh, sorry, 6 weeks. So we had a massive drop for 6 weeks. And then over the past 3 days, it's been going up. And if we take a look at the candles here, there's a couple of things that I look for in technical analysis for any sort of confirmation of a rebound. And the first thing that I'm looking for are the candles to start closing above the 21-day EMA. Now, the good news is we did get a close above the 10-day EMA on Tuesday, and that is definitely the first step. However, it's no guarantee. We had a close above a 10-day here, and yet it just kept dropping after that. So this really isn't quite a guarantee, but it is at least good news. It's going in the right direction. Now, the other thing I look for is a golden cross on the MACD. That's when this gold line crosses above the blue line. And again, back over here, we were getting very close to that golden cross, and then it rejected and continued going back down. So again, as of Tuesday, we don't quite yet have that golden cross. We would need to see this histogram here go from red to green, as it was green over here, go from red to green. We'll need to see the gold line get above the blue line. If that happens on Wednesday, that will be our first indication of confirmation on a rebound. But until that happens, we might still continue to drop. So as of Tuesday, looking at technical analysis, we're certainly trending in the right direction. However, we have no confirmation of a rebound yet. So technical analysis alone isn't really going to tell us if we are rebounding or if this is just a bull trap. This could be a bull trap that ends on Tuesday, and from here on out, we continue down. Taking a look at SPY, which is an S&P 500 ETF, and we'll see if we can get any other clarification from this. We might be able to, we might not be able to. Let's take a look. So on the S&P 500, we have a very similar setup here where we were dropping, and then we've got about 3 days of bullishness. Again, we closed above the 10-day EMA, but not the 21-day EMA. We also did not quite yet get that golden cross on the MACD. So unfortunately, the S&P 500 is in the exact same boat as the as the NASDAQ in which it's bullish, but we don't have confirmation yet. So again, Wednesday could go either way. Again, if we can get this golden cross of the MACD on Wednesday, that would be confirmation of a bull run. Okay, so at this point, the technicals are still quite a bit uncertain. While they're certainly indicating we want to go bullish, we want to go on a bull run, there's no guarantee of it yet. So it really could go either way. It could be a bull trap, could be a bull run. We don't know. So unfortunately, we're going to have to dig a little bit deeper. Now, as you guys know, I kind of like market psychology here because with market psychology, this really helps us determine how people are thinking. And when we have the market psychology and extreme fear, that usually points to a bottom in the markets and we start going up from there. So as you can see right here on the CNN's Fear and Greed Index, market psychology is at extreme fear. And this would certainly point to the markets being near a bottom and wanting to continue to go up, continue to rise. And even in a bear market, they can get up to about 35, 39, basically somewhere up in this area up here before we start to top out. So psychologically, it does look like this bull run is going to continue, at least in the short term. And as you can see, with the market momentum still being in extreme fear, we'll need to see this turn around a little bit. Maybe get back up closer to the average. So like we had that big run fall down here a couple weeks ago and it kind of rose back up to the average before falling. I think we can get back up here and get back up to the average before falling again. Now, this is the S&P 500. This would put it back up to around 4,400. Today, we're at, let's see, 4088 versus 4454. See if I can do math on that without pulling it out. So if we do that, we can try to see, we should get 4454 divided by 408885. It's about a, wow, 9% rise from here back to the 125-day moving average before we start falling back down again. So based upon psychology, it looks like we'll get about a 9% rise from here before the market falls. And if we go take a look at the charts and see what a 9% rise would be over on our SPY chart, 408.32 times 1.089, 444. So that would put us, 444 would be right about this level right here, this resistance level. What I want to do right now is I'm going to adjust my Fibonacci retracement. And I want to, if I can get it pulled up here, I don't know if I can. Why is it all the way over there? Crap. I'm trying to adjust my Fibonacci retracement, but it won't even let me select it. I don't know why. Let's come over here, see if I can get this working. I can't. Gosh dang it. Okay, let's just use NASDAQ because I can't get that one to work for some reason. What I want to do is I want to go from the bottom right there. All right, so we'll run this. And if we go up 9% on NASDAQ, that's 306.17 times 1.08. Well, it wasn't exactly 089, 333. So 333, oh, looky here. That's the 38.2%. So it, according to this, we would run up to about 38.2%, which would put us right about here. And so rising up to about right here, and actually it might work out if I move this back up to the actual close. Let's see. Yep. Yeah, somewhere in there. So right about right here is where we should rise back up to before we start falling down again, just based upon psychology. So about another 9% rise up. It'll probably take about another week and a half to get there. So over the next week and a half, by the end of next week, we should be up to this level based upon market psychology. Now, if we do get that rise up, then we'll definitely get the golden cross on the MACD. We'll definitely get the close above the 21-day EMA here. And that is the full confirmation we're looking for. So if the market psychology plays out, then it's going to cause the technicals to play out. And we should get a nice 9% rise in the markets. But the question is, what about after that? Cool. So we get a 9% rise in the markets over the next week and a half. But what about after that? Is Are we going to go back to new all-time highs? Because a lot of people think we are. Or are we just going to keep falling again? Well, in order to answer that question, we're going to have to consider the news, and we're also going to have to consider history. So let's take a break from the charts for a minute, and let's start talking about some of the most recent news, why the market's been going down, and then we'll go look at history and see kind of historically how the market performed, which will give us a good indication of where we're going to go longer term, say for the rest of the year, for example. Now, let's start with why the markets went down. Initially, the market started dropping because of high inflation, right? We had the high inflation, and going into last year, nobody really cared about high inflation. But ultimately, what the high inflation led to was the Fed starting to get very hawkish, meaning the Fed was saying, we're going to actively attack inflation and get it back down. Meaning they're going to have to raise interest rates. They're going to have to sell their bond assets, specifically sell their treasuries, which raises the interest rates on treasuries, which makes it more expensive for the federal government to borrow money, which in turn will cause the federal government to spend less. In addition, that'll get inflation down. In addition, they're going to start selling their mortgage bond assets. That will cause mortgages to rise. And as mortgages rise, the interest rates rise. That'll cause the buying pressure on housing to come down. That should cause housing prices to come down. And that in turn will cause inflation to come down. And then, of course, the Fed's overnight fund rate, which is the rate that you borrow for just about everything else, including auto loans and things like that, that'll cause those interest rates to go up, which should help push the borrowing on those assets down. And in turn, inflation should start coming down. Now, there are certain things the Fed cannot control. For example, they cannot control energy. They also cannot control the cost of food. And that is why when the Fed is looking at inflation, they look at something called core inflation. Core inflation is essentially the inflation rate minus energy and food, the two things the Fed cannot control. Because what they want to do is they really want to look at what they can actually control and how their rising interest rates might help bring down the core inflation. Energy and food is outside of their control. Those are based upon global factors such as the war in Ukraine and wheat exports from Russia and oil and gas exports from Russia and things like that. That all affects oil and food prices, which the Fed can't control. So we know that the stock market's been coming down due to rising interest rates from the Fed. The question is, at what point do those rising interest rates get priced in? And is there any other bad news that could cause the markets to go down further? Because it's very possible that the interest rates at this point are completely priced into the market and everything's priced in. We know what the Fed's going to do. So long as they don't get any more hawkish, we can start going back up. On the other hand, there might be some additional news that causes the stock market to go down further. So let's take a look at the news. First of all, are the interest rates from the Fed pretty much priced in? Well, yes, at the current price, but no if we get a rebound rally. Let me explain what I mean. So at this point here, we had a 25 basis point rate hike in March, and the market really liked that, and we got a nice rally. But certainly the 50 basis point rate hikes for the next 3 times were not priced in, which is why we came down. Now, at this point, what is priced in are 3 50 basis point rate hikes. The last one we had in May, one in June, and then one at the next meeting, then every other 25 basis point rate hike. That's what's priced in at this point, which is why when Jerome Powell spoke today, the market went up because we already knew everything he said. Jerome Powell did not say anything that we did not already know. So it shows that what the Fed is going to do is already priced in. Now, the one thing that Jerome Powell did say, which was a little bit scary, is he said he wants the markets to be forward-looking. He said he wants the markets to anticipate rising interest rates. Now, Jerome Powell seemed like he was not happy about the fact that the market rose the last time they had a Fed meeting back in March. Okay, he was not happy about that at all. And he wants the markets to do what they did after the Fed meeting, which is to continue going down in anticipation of higher interest rate hikes. So if the market gets a rebound rally up 9%, up to this 333, 334 level, Jerome Powell made it pretty clear today he's not going to be happy about that. And they're probably going to start doing some things to get the market back down. You have to understand, in order to get inflation down, asset prices have to come down. That's how you get inflation down. And the two largest assets that have run up massively over the past few years are housing and the stock market. So Jerome Powell needs to see housing and stock market come down. Otherwise, they're not really going to accomplish their goal of getting inflation down. So Jerome Powell basically came out today and said he wants to see the stock market go down further. So that would indicate that after we get this little rebound relief rally here over the next week or two, that Jerome Powell wants to see the market come down further. So on that news, it looks like the market's probably going to go down further. Now, what about outside of that? Is there anything else that might push the market down further? And the answer is a recession. Now, a recession, there's two different types of recessions, okay? There's a paper recession, which is very mild. Most people in the US won't even know we're in a recession outside of the fact that the news will talk about it. And then there's a real recession. This is the one that really hurts people. This is where we get layoffs. This is where we get foreclosures. This is where the economy really starts to hurt and real people get really hurt by the economy. So right now, the way it looks is even if we do get a recession, and there's some indication we might actually be in a recession right now, based upon the fact that Q1 GDP was already negative, and all it takes is 2 quarters of negative GDP for us to be in an official recession. And a recession is just defined as the GDP growth minus inflation. So if GDP is growing substantially high enough, then all we have is inflation, which gives us our real GDP, which technically puts us into a recession. Most Americans aren't even going to know it. It's literally just going to be a paper recession, a recession on paper that does not affect real people. So it's very possible we could be in a paper recession right now, and most people don't even know it. We're not even going to feel it. And I'm about to show you some historical charts, and you're going to realize that if we do enter a paper recession, the Fed won't care. They're going to continue to raise interest rates so long as the jobs market is strong. This is their number one economic indicator they're looking at. So long as the job market remains strong, the Fed will continue to raise interest rates, even if we do enter a paper recession. And I'm going to show you that on the charts. Okay, it's going to blow your mind. Oh, my kids got me this glass a little while ago for Father's Day. Anyway, just drinking my tea here. All right. So what I want to show you guys, I'm going to show you some historical charts here. But before I do, we're going to talk about the possibility of a real recession. Now, what is a real recession? What does that look like? Well, a real recession looks like what happened in 2008, where we had massive layoffs. We had a massive drop in housing prices, which in turn triggered a lot of foreclosures. We had, most importantly for the stock market, we had a significant decline in earnings. Keep in mind that the stock market, ultimately, what it trades upon is earnings. Yes, news like rising interest rates will cause the stock market to go down, but only because people think earnings are going to go down as a result. So the real thing we got to look out for in the stock market is declining earnings. So what I want to do real fast is I want to go over some of the recent news that's been coming out. And I want to look to see if this paper recession that we might be in now could quite possibly at some point in the future turn into a real recession. Now, even if it does, there's two ways this could play out. One is that the paper recession is prolonged, possibly for say 18 months, and it kind of turns into a real recession. The other possibility is we start out with a paper recession, then we kind of get out of it, we forget about it, and then a year or 2 years down the road, it turns into a real recession. So essentially, the way this will show up in history books would be 2 recessions over the course of 3 or 4 years. So those are the two possibilities. So the problem with a recession always is that you just cannot time it, right? Nobody can time a recession. That's always the problem with recessions. There's really, really good indications to show a recession is on the horizon, but nobody can time it. So I'm going to go look to see if a real recession is on the horizon. But just keep in mind that even if a real recession is on the horizon, there's no way to time it. It might happen in 6 months. It might happen in 2 years. So just keep that in mind. All right, let's go take a look at some of the most recent news. All right. So what I wanted to do is let's start with earnings, because the important thing about earnings is the stock market trades upon earnings. And if we start to get a decrease in earnings, we're going to see a continued decrease in the stock market. Now, earnings, just take Walmart. Walmart is one of the stocks that should do extremely well in times of high inflation because people can't afford as much. And so they start going to discount retailers like Walmart. Walmart shares fall as higher costs and supply chain problems and inventories eat into profits. In short, Walmart missed on revenue and profits. They missed, and the stock went down. So here we have a company that should be rising that's actually falling. This is really bad news. This is not a good sign at all, okay? This is sort of the first little indicator that things are not good, that we are, in fact, going to see negative earnings. And as a result, those negative earnings are going to turn into some basically a recession, a real recession. So the next thing I want to do is I want to kind of point out this article that came out today. And in the article, this article, basically what it was talking about is here's what just happened that triggers a stock market drop 71% of the time. And it was really simple. And it was basically summarized in this one quote. Earnings revisions have started to fall, as we've seen with Walmart and many others. 71% of the time when this happens, markets fall over the next quarter. That is over the next 3 months. So we have an indication here that as earnings start to go down, the stock market will continue to fall. But the real question, so we have Jerome Powell, who says he wants to bring the stock market down. We have earnings going down, which is a big indication that the stock market will continue to fall over the next 3 to 6 months. So far it looks pretty bleak. But what I want to do, because ultimately it's going to depend upon the economy, I want to go look at what's happening and seeing if we are starting to get signs of a real recession and if we're starting to get signs of the economy actually slowing down, not just inflation bringing GDP down, but an actual slowdown in the economy. And I'm starting to see a trend. And the trend is layoffs in tech companies. I see an article today. Netflix lays off 150 employees as the streaming service contends with big subscriber losses. Here's the thing. 150 employees at Netflix is nothing. This is literally 2% of their workforce. That's like a normal layoff in a bull market. It's nothing. It's meaningless. But it might be a very, very small indication of a storm brewing. So it's pretty meaningless right now, but just kind of keep your eyes on it because it could be an indication of a storm brewing. By the way, during the financial crisis, when we're talking about layoffs, companies were laying off like 40% of their workforce at once, not 2%, 40%. So this is not the kind of layoff that would trigger a recession. But like I said, it's a warning sign, a little bit of a red flag, if you will. Okay, I got this other story. Wave of layoffs at startups foretell a slow summer for venture investing. Now, essentially what this means is I am seeing a lot of my friends who work at startup companies who are getting laid off. So this came as no surprise. And when you start getting layoffs, when you start getting a downturn in the markets, the funding from venture capitalists dries up. And it kind of makes sense. As a venture capitalist or an angel investor, your whole goal is to invest in a company, take that company public, and then have this IPO for a huge amount of money. Well, nobody wants to take a company public when the stock market is dropping. You want to take a company public when it's near an all-time high, which is why last year we started getting a record number of IPOs. And that was a huge red flag that we were about to enter into a bear market. In fact, it was one of my main reasons why I thought we were going to enter into a bear market in 2022, is because we had a massive amount of IPOs. And these angel investors, it's venture capitalists, they do IPOs when the stock market is at all-time highs, when the stock market's overvalued, because that's when you get the most amount of money for an IPO. And that's when these venture capitalists can make the most amount of profit by selling. So as the stock market starts to come down, people stop investing money into startups. They stop investing money into the venture capitalists, stop investing, the angel investors stop investing. And as startups stop getting money coming in, they're no longer able to pay their employees because most startups lose money at first. And so they're forced to start doing layoffs. So we are getting layoffs in startups, a lot of layoffs in a lot of startups. But this, again, isn't necessarily an indication of a recession. It's just another red flag. This is more of an indication of the fact that the stock market is going down. That's all this is. You got to extrapolate this out. Stock market going down, less venture funding, less funding. They can't pay their employees. They have to do layoffs. So again, not exactly an indication of a recession yet, but another red flag. So we'll have to keep our eye on it. And this was another article I saw. Tech layoffs loom as more companies announce big cuts to their workforces, including large startups, firms, Carvana, Cameo Vroom, things like that. Somewhere down this article, it kind of goes through it. So let's go look at these percentages, and let's see if we're getting up to that 30, 40%, or if we're still down around that 2-3%. So if we get down here, we got Doma. They let off 15% of its staff, and they are a digital title insurer. They're unable to turn a profit. Okay, so 15%, it's a little bit more significant. Zwift, which is similar to Peloton, I can't even pronounce it, similar to Peloton, 150 layoffs. I'm not really sure what percentage that is, so moving on. Data Robot, this is an AI startup. They laid off 7%. Not significant. Again, kind of has to do with the loss of your funding. Reef, which is another Miami-based tech company, they're down 5% of their workforce. Not significant, but another red flag. Now, Cameo here, they let off 25% of their workforce. That's a little bit more significant, right? And then you got other ones where Robinhood cut 340 jobs, Netflix 25, although we just saw that's up to 150 now. And then Noom got rid of 500. So all in all, we are definitely seeing more and more signs of layoffs and more signs of recession coming. But again, so far, this is limited to tech companies and startups. This is venture capitalists that are not giving as much money out. Funding fell 13% quarter over quarter, and that's leading to these startups just not having the funds to continue to pay their employees. So for now, it's not a true indication of recession. It's just the market's going down. But just keep in mind, this is how it starts, okay? This is how it starts. The venture capitalists stop investing. Layoffs start. We start getting more and more jobless claims, right? That starts to hurt the economy. And then very slowly over time, those people who get laid off from these tech companies, they can't afford to buy products. That causes other companies to lose profits. Then they start to do layoffs, and it just balloons. It literally just goes out of control and balloons, right? So we've really got to be careful about this. Again, no true signs of a recession yet, but definitely a lot of very early indicators and a lot of red flags. Okay, so that's the news-wise. Now what I want to do is we're going to take a look at some historical charts and patterns, and I'm going to show you historically what's happened in the stock market with rising inflation, rising interest rates, and this will give us a much better indication of where the stock market might actually go. Okay, now, current inflation. And by the way, this is an inflation chart going back pretty far. just a table of historical inflation rates. Okay. And this is broken down by month. The last number here is the annual average, which I'm going to show you on a chart in a minute. But I want to start with the monthly numbers. So right now, inflation rose up to 8.5% in March, dropped a little bit to 8.3% in April, but nothing significant enough to even really count as a drop. Now, what I want to point out is this. Everybody sees this inflation number at 8.5%. And they all say it's the worst inflation in 40 years. And everybody wants to go back 40 years to 1981. They want to compare that period to 1981. And if you go compare that period to 1981, what you'll notice is the stock market went on a massive rally. And so a lot of YouTubers have this huge misconception that if you go back and you look at 1981, that's the best comparison, the last time we had inflation this high, and the stock market went on a massive rally. But they make a grave mistake in their analysis. Let me show you what the mistake is. So keep this number in mind, 8.5, 8.3, 7.9, basically around 8, right? A little over 8. I'm going to go back to that period in 1981. And actually 1982, 40 years ago. And whoops, what did I just do? Okay, so 1982, we were at 8.4%. And so this is the headline number you see in the news, the one everybody talks about, worst inflation in 40 years. And in fact, if you go back and you look at the stock market starting in 1982, it did in fact go on a massive bull run starting in 1982, lasting all the way up through 1987, which was the stock market crash. Now, there's a major flaw in comparing the current stock market to 1982. And that major flaw is this. In 1982, interest rates were dropping. They were on the decline. In fact, by the end of the year, they were down to 3.8%. But last year, going into the beginning of this year, when everybody was talking about 1982, what was actually happening before that? You had interest rates declining, but what was happening in our market? Interest rates were going up. Or inflation, I'm sorry, not interest rate, inflation. Inflation was going up. 4.2, 5, 6, 7, 7.5, 8, 8.3. So it's a grave mistake to compare a time of rising inflation to a time of declining inflation. It's a grave mistake I did it again. It's a grave mistake. Oh my gosh, I can't. Anyway, it's a great mistake to compare these two time periods. You don't want to compare a time of declining inflation to a time of increasing inflation and try to do an apples to apples comparison. It doesn't work. Now, once inflation does actually start going down, could we get a nice bull run? Yeah, absolutely. Just like we did in 1981. But as inflation goes up, let's go look at the correct time period, the time period where inflation was actually rising. And it wasn't 1981, because by that time it was already coming down. We got to go back further. We got to go back earlier. And if we do go back earlier, we end up in this period right up here, the first time it rose in 1973. In 1973, we were rising up, and we actually finished the year out at 8.7%. 8.3, 8.7. It's exactly where it is today. Now, what was happening in 1983? Well, in addition to inflation rising, we also had oil prices at an all-time high. There was an oil embargo, and oil prices were sky high. And not only were oil prices sky high, but there was a significant supply chain shortage when it came to oil, as well as a few other things. What do we have today? We have rising inflation, oil prices sky high, and a significant supply chain shortage. So if you want to do a historical comparison in the stock market, you have to go back to 1973, because that is the point that was most comparable to where we are today. Now, no two time periods are 100% identical. And anybody can go look at any two time periods and say, yeah, but this time it's different. I want to warn you, though. There's an old saying on Wall Street, and the saying goes like this. The most famous saying on Wall Street is, this time is different. Why is that the most famous saying on Wall Street? Because every single time somebody says this time is different, and yet every single time history repeats itself over and over and over again. Every single bubble, people say this time is different, and yet every single bubble bursts and the asset values come down. This time is not different. Don't make that mistake. You can always dig in and try to find differences. The key to doing any sort of historical analysis is to try to find as many similarities as possible and then go with it and see what the market did. Market's not going to react 100% the same, but 99% of the time it will react very similarly. All right, so what I want to do right now is I want to go over this and I want to kind of show you guys how the stock market reacted, how inflation happened, how interest rates rose. And keep in mind this time period, 1973, when inflation was rising, and then 1981, or specifically 1982, sorry, when it came back down. So remember the time period, 1973, rising inflation, 1982, lowering inflation. Remember those time periods, okay? So what I'm going to do now is we're going to pull up some charts. And this guy and this guy. Okay. So I got some charts here, okay? And what I want to do, and I'll see if I can make this a little bit clearer for you. Okay, cool. Okay. Now, on the chart on the left, what we have is we have inflation on our left over here, okay? So there you go. So on the left, we've got inflation. And on the right, we got the Fed's raising interest rate. And then the gray bars here, this is a recession. So anywhere you see a gray bar, that was a recession. Anywhere you see the chart on the right is rising fund rates, and the chart on the left is inflation. Now, remember that on this chart, the way this is broken down is this is a monthly, January, February, all the way to December, and then the last number is the average, okay? So the charts that I have over here, unfortunately, it's not broken down by month. It's only broken down by year. So this is going to be the average for the year. So just keep that in mind. But let's go back to 1973. And 1973, this is the point at which inflation was rising to the levels where it's at today. Okay, 8%. And then by 1974, the average was 11%. But regardless, rising inflation. So what happened if we just start looking at inflation? We saw inflation rise, and then we entered a recession. As soon as we entered that recession, inflation started coming back down. Okay. Then inflation starts rising again. As soon as it starts rising again, what happens? We enter another recession. And then inflation starts coming down. We enter another recession. And then inflation finally bottoms out in 1986. But really, take a look. 1983, we got back down to 3%, which is our nominal inflation rate in the US. So from that period, from 1973 to 1983, it took 10 years for inflation to get back down to a nominal rate. And during those 10 years, we had three recessions in 10 years. Now, let's see what the Fed did in order to fight inflation during that time. Let's start with 1973. So in 1973 to 1974, we had inflation rising. Let's come on over here. And 1973 to 1974, what do we have? We have interest rates rising, do we not? So we have inflation rising, we have interest rates rising. Now, once we enter the recession, and the Fed knew we were actually in a recession. Keep in mind the recessions are 6 months back looking. Actually, they're 7 months, okay? Because it takes about a month before we get the quarterly data. It takes 2 quarters of negative GDP. So literally, it takes 7 months from the time we enter a recession before we know we're in a recession. And sure enough, about 7 months after we enter the recession, what does the Fed do in 1974? They start lowering interest rates. Now, here's the tricky thing. In July 1974, they start lowering interest rates, and they continue to lower them through May of 1975. And they do that to get us out of a recession. So July 1974. I'm going to go back over to the actual chart here. I'm going to go back down to 1974. Let me show you what happened to inflation. As the Fed starts to lower their interest rates, inflation continues to be sky high. So they lowered the interest rates to get us out of a recession, but that basically caused inflation to go up. Now, watch what happens next, okay? So after that, we get this bottom here in 1976, okay? And starting in 1976, inflation starts to go up again. All right. So this is 1973. Inflation's where it's at today. 3 years later, inflation starts to go up again. Okay. And during that period, 1976 to 1980, the Fed, what do? They raised the interest rates in order to fight inflation. This is what the Fed does. And what did that do? That triggered a recession. Once again, right here, it's kind of hard to see on the graph, but as soon as we entered a recession, the Fed lowered interest rates, get us out of recession. As soon as we got out of the recession, they had to raise interest rates again to fight off the inflation. That ultimately in 1981 triggers another recession. And then in 1981, they start lowering interest rates to get us out of a recession. Now, inflation continues to rise, but look what happens in 1981 with inflation. At this recession, inflation starts coming down and it continues to come down on its own. So starting in 1981, even as the Fed was lowering interest rates, the inflation was kind of coming down on its own, right? Now, this is what the Fed thinks is going to happen right now. The Fed thinks that we are basically in this 1981 period, and the Fed thinks, yeah, we're probably going to enter a recession, but inflation is going to come down on its own. And once it does, the Fed's going to be able to stop raising interest rates, and they're going to be able to start lowering interest rates to get us out of the recession. And as they do, inflation is going to come down on its own. That's what the Fed believes. This is the Fed's soft landing, if you will. But historically, there's also a chance that inflation continues to rise as the Fed kind of pulls us out of recession, and then we kind of get back into a rising inflation again. So there's a chance for that, right? So this is a warning. It may not be what the Fed thinks. The Fed is looking at a best case scenario here, and it may not actually be the case. But what I want to point out, and this is really important, is what happened to the stock market during this time. Because as the Fed was going through this time period in 1973, and they started raising interest rates and inflation starts going high, and then we got a little bit of relief in 1975, but then inflation starts going up and then interest rates start going up again. What happened to the stock market? And then more importantly, what happened to the stock market in 1981? Well, keep in mind, 1981 is a little bit easier to understand because in 1981, not only did we have inflation going down, but we also had interest rates going down. It was a double bullish scenario. Inflation going down, interest rates going down, bullish. You would expect the stock market to go on a massive rally starting in 1981. Now I'm going to pull up the Dow Jones Industrial Average because the Dow Jones is the best chart we have to look at what happened in the stock market. Because the Dow Jones does something really cool in that it hasn't really added or taken away a lot of stocks over the years. The NASDAQ has added significantly more expensive stocks. So is the S&P. So the weighting in the NASDAQ and S&P really hasn't been consistent over the years. But in the Dow Jones, it's been very consistent. So anytime you're doing historical analysis, you definitely want to look at the Dow Jones. So let's go look at the Dow Jones and look at what happened during this time period as all this stuff was going on. So I'm going to move this chart over here. Again, this is our interest rates. Let's go look at the Dow Jones. So let's start in this 1981 period. And in 1981, we were in this middle of the recession, the gray bar here. And what did the stock market do? It bottomed out in the recession in 1982. Look here, right? Bottomed out right there in the recession. Check that out. Into the recession, it bottoms out. And the Fed funds rate starts to drop. And what does the stock market do? It starts to rally. Makes sense. When you got inflation going down, you got the Fed funds rate going down, the stock market rallies. But what happens when the Fed raises interest rates? Does the stock market rally? Well, here's another misconception amongst YouTubers. YouTubers very often will go look at time periods where the Fed raised interest rates when the economy was strong. For example, they look at this period here from 1992 to 1995. And they say, well, look what happened in 1992 to 1995. We had a massive bull run as the Fed raised interest rates. And we did because the economy was strong and inflation was low. What about during this period here? From 2004 to 2006, the Fed raised interest rates. And from 2004 to 2006, it's kind of hard to see here, but the stock market went up. And of course it should, because the economy was strong and inflation was low. But this is another misconception, and it's just bad historical analysis. Because this time the Fed is not raising interest rates because the economy is strong. The Fed is raising interest rates because it's trying to fight inflation. So what happened to the stock market the last time the Fed raised interest rates for the purpose of fighting inflation, which actually did not make the economy strong, it made the economy weaker. Let's take a look. So again, in 1973, we had inflation going up. We had the Fed funds rate going up to fight inflation around the same inflation rates that we have right now. And let's go take a look at what happened in the stock market in 1973 to 74. Well, here we are in 1972. We actually hit a peak in 1973. Specifically, we hit that peak in January 1973. Sounds very similar to where we are today, hitting a peak in January of 2022. Then what happened to the stock market is the Fed started raising interest rates and inflation was high. The stock market dropped from 6,780 all the way down to 3,433 over the course of 2 years. Okay, so do a little bit of math on that to kind of show you how much of a drop that was. Went from 6,943 and 1974 hit this low here at 3,473. The 49.9% drop in the market, 50% drop in the market from highs. So the Dow Jones dropped 50% from highs from 1972 to 1974 in 2 years as inflation was high and the Fed was raising interest rates in order to fight inflation. As a result, the stock market went down 50% and we entered a recession. So if you want to do true historical analysis, you got to go back to 1973. Almost identical scenario to where we have today with high inflation, rising interest rates, high oil prices. We had a 2-year drop in the stock market, a 50% drop in the stock market, and a major recession. So historically, we're in for a lot of pain. And by the way, I'm not even going to talk about what happened after that, because remember, inflation started rising again after that point, and the Fed, this is where it just got crazy, right? That we ended up like 20% interest rates. And of course, at that point, the stock market just continued to go even lower because the stock market's going to go down when inflation is high and the Fed's raising interest rates. So look at this, 50% drop from 1972 to 1974. So historically, when the Fed raises interest rates to fight inflation, the stock market goes down a lot and we enter a recession. Stock market, the S&P 500 right now is down about 18% at its low. The Dow Jones at its low was down 12%, and the the NASDAQ at its low was down 28%. The Dow in 1972 to 1974 dropped 50%. So far, it's only dropped 12%, putting to a further 38% drop in the Dow Jones over the next year and 9 months, if history were to repeat itself. Now, that doesn't assume that inflation increases. I'm not even talking about this period where inflation just went back up again. Remember this? We're looking at this period here where inflation was high and the Fed started raising interest rates. I'm not even talking about what happened when inflation went in 1980s. Forget that. I'm just talking about this period where inflation was where it's at today. Okay? Again, I don't even want to talk about this drop. I'm just talking about this little drop right here. That's it. Just this little tiny drop right here. That's all I'm looking at. That little drop from that time period. Okay? So guys, again, I'm looking at a little tiny sliver, this little drop right here, which is very similar to where we are today. Again, I don't want to get into the massive drop we had here when inflation went sky high and interest rates went to 20%. I want to look at this drop here where inflation was 8% and interest rates went up and we entered a recession. Who knows what's going to happen after that? It's way too hard to predict. All I can do is we can look at the next year or two. So that's everything. I've laid it all out for you guys. That's everything I've got to talk about. There is no clear-cut answer because it's very difficult to predict the future. But in summary, the way we can summarize this is we are getting some very early indications of a real recession with layoffs in startups and tech stocks. We have historical data pointing to a 50% drop in the Dow Jones Industrial Average and a major recession occurring. And we have Jerome Powell saying that he wants the stock market to come down. So all of those combined tend to point to the stock market wanting to fall significantly more from here, even though in the short term, for the next week or two, the technicals point to a 9% rally from Tuesday's close. Okay, that's going to wrap up my entire thesis. I'm just going to go through your comments real fast and see if there's any comments that relate to everything I talked about that I think could add to the discussion, and then we're going to end it. Thank you guys so much for joining us here. If you've stuck around this long, please don't forget to hit that like button and subscribe and help get some things up here. Also wanted to let you know that Wednesday at 7 p.m. Eastern time, I'm going to be on Larry Jones' channel talking about the housing market and how that's going to affect the stock market. You're not going to want to miss it. Okay, let's get into some of your comments here. I'm just going to be quiet for a second as I read these, and we'll talk about some of the things that might kind of affect what we talked about today. So first question is on, Jerome Powell's speech in the Wall Street Journal today. Do you expect a change of Fed's tone in the near future? No. Jerome Powell didn't give any change in his tone at all. It was exactly what he had, been saying. There was really no change in the tone. So no change there. Hi, Scott. Thank you for the spy call. You're welcome. I'm glad you jumped into that, man. That thing was up 120% today. By the way, if you guys made money on either the spy call or the QQQ call, put some curries down in the comment. Just go to your emojis and search curry. You'll see it. Put some courage down in the comments there if you made money on our calls today. And, just a reminder for you guys, if you guys want to know everything I buy and sell before I place the trades, you can sign up for the VIP Discord. We are making money on most of our trades over there. Not all of them, of course, but most of them we are. This year I'm up. The market may be down, but my portfolio is up because we are trading the swings and we are making money. Like I said, 120% profit on that spy call today. So if you guys want to know everything I buy and sell before I place the trades, you can join the VIP Discord, stockcurry.vip/VIP. Okay, let's get into some other things here. And again, if you want my options plays, go join the VIP Discord. That's where I put them all. And yeah, please don't forget to hit the like button. Let's see. Are we currently in a recession? Don't know it yet. Very possible. Very, very high chance of that, actually. But again, paper recession, most people won't even notice it. Good question. What do I think about the VIX level right now? Now, I don't think I can pull up VIX on. Oh, yes, it's on there now. Finally. Thank you. Okay, so here's the thing about the VIX level. I want to kind of, I'm in the 5-minute, go to daily. I want to kind of talk about this for a minute. So a lot of people look at when the stock market normally tops out and goes back down. And they say, I'm going to pull up the weekly chart here. They say we won't get a decline until the VIX gets above 36. And some people say 40. 2018, when the VIX got above 40, that was the bottom of the market and the stock market went up. In 2020, the VIX hit 85. So anybody that bought in when the VIX was at 40 lost a ton of money. So, just giving some random number like that, 40, 36, whatever, saying, okay, well, when the VIX hits it, we're at the top and we're going to bottom out. I don't like that at all because it's just, historically, it's just not true. Playing the VIX, all that really does is shows you how strong the decline is, how fast the market's declining. That's all it really shows you. So I don't think there's any one number that we can get to that says, okay, we hit that number, that's the top, we're going to bottom out. All I can tell you is if you look at the bottom, when we start getting down to 14, we are very low and we are overbought and we're most likely going to go down. Right now, the VIX is 26. Very, very neutral. Doesn't have any meaning whatsoever. So really no thoughts on the VIX other than that. Okay. Okay, guys, if you're playing any sort of inverse ETFs, SPXU, UBXY, anything like that, I want to give you a warning that while these are great for playing short-term drops in the market, these are designed to go down over time. I'm going to go pull up the monthly chart. This is going to blow your mind. So UVXY is currently at $14.52. If I pull up the monthly chart, at one time this was trading at, what was the high on this? The high on this was 100,000 million. So one time this was $1 billion and today it's $14. So UVXY has gone from $1 billion to $14 in the last 11 years. Guys, the inverse ETFs are designed to go down over time. So I want to stress you do not want to hold these longer than 1 week. If you hold them longer than 1 week, there's a very good chance you're going to lose money. So just a little warning there. Great for short-term plays, terrible for long-term holds. All right, let's see what else. All right, I'm just reading through your comments some more. It's a good point. China lockdown hurting. Let me talk about this real fast. So a lot of you guys have only been investing for the last year or two. You're not aware of this, but what triggered the financial crisis in 2000, really it started in 2007. The stock market started tanking in 2008, but the financial crisis started in 2007. And what triggered it was actually, believe it or not, nothing in the United States. What triggered it was Asia. The Asian economy started going down pretty significantly starting in 2007. And that eventually made its way over to the United States. Now, obviously, the lockdowns in China are hurting. And China's economy is in contraction right now. And other Asian economies are feeling the pain too. And of course, now it's starting to affect Europe. We're starting to see Europe's economy start to contract. The US already had negative GDP last quarter. So what we're starting to see is a global slowdown. Now, when we get a global slowdown, that is when we start getting a massive financial crisis. So in my lifetime, there's only been 2 global slowdowns. One was in 1987, where we had a massive stock market crash. And the other global slowdown was in 2007, 2008, where we had the financial crisis. And I'm telling you, global slowdowns create major recessions. So the Asian and European economies are something we're going to have to keep our eyes on because this will affect the U.S. stock market and could put the U.S. into a major recession and, in fact, a worldwide recession. There are some economists, not very many, but there's a few people who actually think that the recession we're going to get over the next year or two is actually going to be worse than 2008. Now, I don't believe that, but there are some people who do. So just keep that in mind. All right, let me see what else we got here. All right, anything else that might be important to talk about? Yeah, like we've said before, the biggest mistake in Wall Street is thinking that this time is different. Tomorrow on Larry Jones' channel at 7 p.m. Eastern time, I'm actually going to be talking about the housing market and how it compares to 2008. So don't miss that because it's going to be good. I think you're going to like what I have to say. No, you're going to hate what I have to say, but it's going to be really important to know and understand. So it's going to make you a better trader. All right, let's keep going here. Just kind of reading through your comments, seeing what else we got here. Let's see. Just trying to see if we got anything else we haven't talked about that's kind of important. Yeah, just a quick mention about cryptocurrencies. Keep in mind that cryptocurrencies follow the overall market right now. And more importantly, cryptocurrencies fall faster than the market falls, and they rise faster than the market rises. So, as the market goes down, we can expect cryptocurrency to go down even faster. So just keep that in mind. It's not looking good for cryptocurrencies right now, and we could see some significant drops in cryptocurrencies. Like I said, I do expect Bitcoin to get down to 19.5, but if for some reason it were to continue to fall below that, we'd be looking at 12.5. So just keep that in mind. Cryptocurrencies, not a good play right now. Let's see what else we got. Let me let's talk about the stock market dropping. I want to give you a reminder of a video I did a little bit longer ago that uh, historically during a midterm election in the United States, the stock market will actually drop through October, and then October it kind of bottoms out, and then November it starts going back up. So, based on that sort of midterm historical analysis, there's at least a chance that we will get a little bit of a rally from October through December of this year. So just keep that in mind. We may get a major sell off and then a rally really the last 2 months of the year after the presidential election. So that would be a more of a major bull trap because we could see like a 25-30% rebound in stocks the last 2 months of the year, which is going to make a lot of people think we're at the bottom, only to see the stock market continue to fall in 2023. So just keep that in mind. There's a good chance the stocks, if they do continue to fall, might stop falling in October, just based upon, again, historical analysis. All right. Let's see what else we got today. Let's see. Just trying to see if there's anything else that kind of deals with what we're talking about here. Let's see. Okay, this kind of goes in with the economy. There's a misconception right now that people don't want to work. I want to clarify that the unemployment rate in the United States is at one of the lowest in history. People are working, everybody's working. So why are there 10 million jobs still out there? Well, the reason is because there's literally not enough people to fill the jobs. We have one of the lowest unemployment rates in history. It's not that people don't want to work. Everybody is out there working. Everybody's got jobs. We still have a 10 million workforce shortage. There's just not enough people to fill the jobs, which could actually probably be a good thing because as people get laid off, they're going to be able to immediately go out and find another job, which if layoffs are going to trigger a recession, it's going to be very delayed because there's so many unfilled jobs are out there right now that anybody that gets laid off should be able to immediately go find another job. So I think it's going to take a long time to work through the backlog of unfilled jobs before layoffs actually start affecting the economy. That would be a good indication that if layoffs trigger a recession, it's probably not going to happen this year. It probably won't happen until next year. So it may be one of those cases where we get a little paper recession now, but the real recession doesn't start till next year. So just keep that in mind. I want to clarify that. It's a little misconception some people have. Let's see what else we got. Just trying to see if we have any other market comments here. Got some curries in the comments. Thank you guys so much. So happy to see you guys making money with us. Very, very happy to see that. Love, love, love to see it. If you guys want to make money as the market's going down, come join us, guys. I've put all the trade alerts out there, and like I said, the VIP members, they know uh, when I'm buying and selling before I even do it. I usually let people know way ahead of time. All right, let's see. Not going to talk about individual stocks. I'd love to talk about that one, but I'm going to refrain. Let's see. All right, I'm not seeing a lot more. All right, I think that's about it. I'm just going to wrap up with this. We're going to talk about the housing market tomorrow at 7 p.m. on Larry Jones' channel. I want to thank you guys once again for joining us. Again, if you haven't done it already, please hit that like button and subscribe. It really helps out the channel. Join us on Larry Jones' page Wednesday at 7 p.m. I'm going to talk about the housing market. We're going to go over it. And once again, if you want to know everything we're buying and selling, if you want to make money as the market's going down, come join us in the VIP Discord and come make money with us. We've got, well over 400 people in there right now. We've got dozens more that are on a wait list trying to get in. Once we hit 1,000, I'm going to cut it off. Once we hit 1,000, there will be nobody else that will be allowed in. I want to keep this kind of exclusive. And at the rate of signups, the rate we're going, people asked, when are you going to hit 1,000? Probably in about maybe 6 to 7 weeks, we'll hit that 1,000. So you got a little bit of time. But if you want to join it, I just want to let you know we're going to kind of cut it off here at some point. So again, thank you guys so much for joining. I really appreciate it. Hit the like button, hit subscribe. I hope you guys have a lot of success trading, and I will see you tomorrow.